Good afternoon. Hello and welcome to today's presentation on HR and benefits diligence, how to protect yourself and uncover opportunity. Hope everyone can hear me and you should be able to see our slide presentation as well in front of you. If you can't, please let us know. Just some housekeeping before we get started. If you do have any questions, there is a chat or there's a Q&A feature, excuse me. If you want to type your questions in there, we'll be happy to answer them during the presentation as well too. And if we're not able to get to them during the presentation, we can also reach out to you via email. We'll answer those questions and get you some responses to those answers as well too. Without further ado, I want to introduce myself. My name is Anthony Knight. I'm the Assistant General Counsel at Aspen HR. I'm joined by my colleague and boss, Mark Sinatra, CEO of Aspen HR. Hey, Mark, how's it going?
Doing well, Anthony. Thank you, everybody, for joining us today. One of the ways that we set ourselves apart at Aspen is providing our clients with, a look under the hood in terms of, their HR diligence and benefits diligence on target acquisitions. We have a lot of clients that are growing through acquisition. And so for the clients that are on this, when you have an acquisition that you're evaluating, take advantage of this service. Like I said, we will go into the detail today, but there's a lot of key aspects of from an HR and benefits perspective that you need to be made aware of that we can help you analyze and evaluate. So that's what we're going to go through today. I'm going to turn it back to Anthony to start the session.
Yeah, thanks, Mark. Well said. We do have a pretty loaded topics today. We're going to focus both on HR and information that you should be requesting, right? Things you should consider during your due diligence process. And then we'll go into the benefits side at the end, and Mark will talk more specifically about that as well, too. So first here, just going to give you an agenda right in front of you. I'm not going to read it all for you, but these are the key topics we're going to be talking about today. I know we have, limited time and everybody's looking for the meat and potatoes of the conversation. So let me go ahead and get started. But first, I do like to have a little bit of fun. So I do have a couple of memes here in front of you to lighten the mood and also bring a little bit of HR humor to you. First is a despicable meme, excuse me, and I love this one. It's sort of how a plan goes wrong, or right, or where you can't expect for a plan. So it says acquire a company, increase your sales, deal with employee complaints, and then he's looking back at it again, deal with employee complaints. Mark, we bring this up because it's, this is something that you really deal with when you take over a company. We talk to searchers all the time. They're excited to buy the company, to look at the numbers, right? They know all the numbers. They want to sell the widget or the product. But when you buy a company, you take over people, right? And when you take over people, you take over everything that is involved with that. And so we like to point that out, right? And we do that in a little bit of a humorous way. I know Mark loves his stand-up comedy, so figured I'd give him a little bit of comedy right off the top.
It is one of the most critical things is to when you're evaluating a transaction to not ignore the human element and to really understand how the transaction and acquisition is going to impact the employees of that target company. And so, yeah, that's why we wanted to at least start with today. That said, there are some really critical compliance considerations that you need to evaluate as well. So, Anthony, you want to dive into that?
Absolutely. So we're going to talk about our first topic today, which is the purchase type, right? And ultimately, there's generally two most common ways to structure the sale of a business, right? Or for you, the purchase of a business. And that's either through an asset or a stock purchase. Now, there are other creative ways, and sometimes you could have a mix of two. But for the sake of time, we're going to focus on just these two types, right? And we're going to talk high level and give you a little bit of detail about the types of ramifications that could come from each purchase type. And so really, ultimately the structure of the deal is critical to several different things, right? You could have tax obligations that change. You could have legal and regulatory, administrative, and even when it comes to the HR side of things, right, and the benefit side of things, they also can be impacted. So traditionally, when you think of an asset purchase, this is you purchasing the assets of the company, right? The equipment, the real estate, ultimately the property that's involved with it. And most of the time, this is this is a favorable purchase type to the buyers of the business, right, rather than the seller. And one of those big reasons are, right, is you reduce your liability, right, and your exposure that comes with that liability from the purchase. Like I said, generally buyers will prefer an asset deal. There are obviously opportunities and differences in which a stock deal can be preferential. But this is the one we normally see. Now, for our perspectives, right, in an asset deal, the number one thing you need to understand, right, is that you are not buying the FEIN, right, or the tax number of and the tax identification of the actual company that the seller is selling. So on day one, you need to be ready to set all of that up. So you have your own FEIN, you have your own business registrations, you have things in your name or that company name right from the beginning. And so that includes, payroll accounts, registering tax accounts, bank accounts, your workers' comp, and your insurance. So it is, a tall task at the beginning to get those things set up, but there are ways to mitigate that. Mark, do you have anything in particular you think could be helpful either during an asset deal or maybe something to be worried about for these
I
folks?
think it's just really like this planning in advance, and particularly if you're looking at buying a company that's going to be carved out from a larger company, which we see on occasion, and certainly in those cases, the target company is not going to have anything set up, day one, and they're going to have to come under your company's existing insurance policies and EIN. So I think the key is like don't have this be an afterthought. Make sure based on the structure of the transaction, if it's an asset or stock purchase, to plan in advance to ensure that payroll is going to be processed on time, accurately, seamlessly. Post close is obviously number one, and right up there, as well as to ensure that all insurance coverages are going to remain in place, or if you're going to have new insurance plans post close, making sure you understand the time involved that it will take for that to be installed and enforce day one.
Yeah, I think you make a really good point there, right? Having payroll set up day one, that is something you cannot mess up right at the beginning, right? If you take over and we talk about people and payroll isn't set up and you miss a pay date or pay has to be, for some reason pushed back, that's not a lasting first impression that you want on your people. And so it's really important to understand that, like in an asset deal, that payroll processing needs to be set up day one, and that needs to be the number one target when it comes to these types of things. So we'll move on to the stock purchase side of things. And with the stock deal, I don't normally like to say like it's the exact opposite, right? Because it's not. There are still some considerations to consider. But generally, this is something that is um, uh, provides favorable tax treatment for the seller, and so sellers may prefer this. Now, there are opportunities, right, when a stock deal could very much be favorable to the buyer as well, too. I like to think of like licensing considerations is also something you can consider there. But the primary difference, right, is the fact that the FEIN you take over, right, as the buyer of the deal. And so what that means is you don't necessarily need to set up everything on day one. You do take on the FEIN, and so things that the FEIN had already in place, your payroll, your benefits, they can traditionally remain in place under a stock or an equity purchase. But the one reason why we think that this is a disadvantage when it comes to the buyer's point of view is when you take on a stock deal, excuse me, and you take on that FEIN or that EIN of the company, you do take on potentially a lot of their potential liabilities as well too. And so those liabilities can manifest really in a couple different ways, right? So if there's unpaid taxes that are under that EIN, if there's debts owed, if there's pending litigation, all of those could potentially come under your liability, right? Because you own that specific company now, right? In that specific entity. Now, there are ways, of course, and Mark, you could talk about this a little bit more detail to limit that liability, using indemnity or add backs or some type of reps and warranties throughout the process. but you need to understand going into a stock purchase that those are the potential concerns there.
Yeah, that well said. I'll just kind of leave this slide with this last thought. What a lot of folks don't realize is the number one cause of an indemnification claim post-transaction, it's usually something relating to HR or something employee related
Mm-hmm.
that was not disclosed to the buyer before the deal was consummated. So again, really important to ask all the right questions, ask, to see all the documents that you need to ensure you have a complete picture of the HR compliance risk that you're going to be
Yep.
inheriting in a stock transaction.
Yeah, that's well said. And I think another, potential thought process to go through is you may say, well, listen, I've got it covered in my indemnity protections, right? I've got it written out in my reps and warranties. I have add backs. But at the end of the day, you have to try and actually enforce those provisions, and that's going to be, potentially costly and time consuming if the seller fights you on that. And so, yes, you may have the protections built in, but it's something that you still have to enforce, right? And that could be something that's timely as well too. And so, understanding what those risks are ahead of time is just majorly important, right? It's extremely important. And when you go through the HR diligence process, right, you can find those out, right? Understanding if there has been EPLI claims in the past, understanding if there is any unpaid state taxes or things of that nature, right? And so it's really important to look through that and go through that to make sure that it's all there, so that you don't have to build in, or even if you do, you have an idea of what it could potentially look like, if that time comes, right? So we'll go ahead and move on to the next topic, which is a pretty big topic. Traditionally in HR due diligence, it's really recommended to have a wage and hour audit. And a wage and hour audit is a review of employee classifications, payroll structure, compliance with different state, local, and federal wage and hour laws. And it's really to dig in and understand like what the potential exposure there is, what types of things that are done that are potentially misclassifying employees, and understand that if you can correct those ahead of time, right, prior to taking over, or if it's something you need to do day one, right, and correct it. So the big things that we see a lot of times, right, is we'll have, buyers come to us. They've identified a target company. They're probably under LOI already. And one of the first questions we ask is, okay, how many employees, right? And what is the breakout of employees? How many independent contractors versus how many W-2 employees? And one of the things that we can hear that could traditionally be a red flag right off the top is, I've got 15 independent contractors all in California. Okay, well, we're going to take a step back, right? And we're going to really think about if that's proper, right? I'll say normally it is something that gives us a little bit of a concern and red flags. Depending on the state, states don't really love the independent. Some states don't love the independent contractor relationship, and for fear of possible misclassification, there could be back wages that are owed. There could be overtime that's owed, and there could be back taxes, right, as well. And so when we go through that process, one of the things we do look at is really we do a high level review to see, okay, should these people be properly classified as independent contractors? Now, from the seller's perspective, they could be doing this for a couple different reasons, right? Maybe they're just not as familiar in the laws and they have misclassified. Maybe these people really are acting in a contractor nature, right? And they very much are an independent contractor based on what type of work they're performing, their level of direct and control over these individuals. Or, ultimately it could be somebody who's doing something nefarious, right? They're trying to avoid payroll taxes. They're trying to avoid paying out benefits. And that's not a seller you want to buy from, right? Because you're coming from somewhere that's a negative from the start, and having to make all those changes is going to be a pretty big hurdle to overcome. And so that's a big thing that we look at right off the top. As we get into a little bit more detailed, if it is just employees, we then look at the exemptions of the employees, right, to ensure that they are either correctly classified as hourly, or if potentially you do have some employees that are salaried non-exempt. And when I say non-exempt, I mean exempt from the overtime statutes. So we go through your payroll records, we look at the job descriptions and things that we recommend you do as well too. and really understand what is this employee base, right? Or do we have a lot of timekeeping that's going to be with hourly employees? Do we have a lot of salaried exempt employees, and we should review the exemptions to make sure they are properly exempt both under federal and state laws. They will change. And understanding where your employees are located as well too. I mean, that's a big one that we see all the time. And one of the first questions we ask is, okay, is this a brick and mortar company? Is everybody going to be at the same place? Are you going to have folks all over the country nationwide? Post COVID, we do see a lot of employers now having remote workforces, or people working in different states who have just naturally sort of moved away, right, as they needed. And one really important thing to note is, like, as you have employees in those different states, you've now opened yourself up to those employee or those state compliance is, and so you have to make sure that you meet the compliance obligations of each one of those states, which can be, a lot to overcome for a new business owner, right? And so we make sure that we go through that. We look at these all. Another thing we do is just to make sure that they're meeting the minimum wage and overtime requirements, right? These are pretty standard things, and it's easy to look at a payroll and determine, okay, is everybody being paid the minimum wage? Is everybody who is working overtime being paid overtime? And go through each one of those things just to make sure and check the box that that's all done. The reason why this could be a concern, right, is because if these are incorrect, you could have back wages, you could have unpaid overtime, you could have, interest tacked onto that. You could have liquidated damages, which for most purposes are what are considered double damages. So let's say they owe 10,000 in overtime, you potentially have another 10,000 in liquidated damages that could be added onto that. And then a big concern, right, depending on how many people are impacted by this, there could be class action lawsuits that come from this. So, we don't say this to scare you, but we think that this is a really important topic as well too, that understanding what your payroll shows, right? What types of employees you have there and what their classifications look like. Another big thing is we have a lot of states now that have, very specific meal and rest breaks laws. We have states with salary transparency rules. So there's a lot of things out there that you just need to be aware of and see, is this target company complying with those things? And if not, can we get them to comply ahead of time, right? Or can we correct it ahead of time to make sure when you take over day one, you're not inheriting all of that mess, right? All of those non-compliance topics. Mark, anything here that you've seen in your experience?
It was really good.
Yeah.
Just like one thing that I would add is, I think the salary threshold for the exempt, non-exempt, I think is increased rather significantly. So, there could be a scenario where you're looking at acquiring a business, and you'll see that there are, could be some employees that, are exempt, but they're below the new salary threshold, and say that, adds up, to $50,000, right? Well, that would be in my mind definitely a negotiating point, because you're going to have to incur that $50,000 if you raise those employees to the threshold post close. So this is why all this stuff is really, really important to do and analyze, during due diligence.
Yeah, that's a good point. And that goes to the topic of, your compliance obligations are always changing, right? And you've got to make sure that you're changing with them. And so if this is a first-time seller, right, or if this is a family practice, and they just don't have that built-in HR functionality, or they're not working with, a PEO or some type of HR consulting service, they could be behind on these things just because they're not aware of them, right? Or it's so new. Mark's right. In July, the DOL salary threshold did increase. It's actually going to increase again on January 1, pending any types of litigation. And at the state level, they change constantly, right? As states upgrade their minimum wage, right, their salary thresholds traditionally upgrade to or increase to match that, right? And so these are sort of moving goalposts you have to make sure that you're keeping up with. And I think ultimately, I think Mark made another good point, right? Is factoring this into the deal setting, right? And one of the ways to look at it is actually from a people perspective as well too, because potentially if somebody has been misclassified this entire time, even if you go to change that, we've seen employees push back, right? They like being salary, right? They like receiving that same pay each year, right? And in some circumstances, they also it's sort of a class thing, right? They like having I'm a salaried employee, right, rather than an hourly employee. And so you may get pushback as well too. And so that's something to consider, is that the change might not be as easy as you want, because you may make the change from the employer's point of view, but you may have now just disgruntled an employee, even though they're potentially going to make more money because now they have overtime available to them. And it's something to consider as well too from an employee perspective. And I think it's always good to keep going back to how this actually impacts the employees, because it's real world stuff, right? At the end of the day, it's not just talking about the laws. Okay, so we'll go ahead and we'll continue actually to the next slide. This is a big one that we see, really with most of the time blue collar groups. So small family run businesses, maybe first time sellers, or just blue collar groups across the country. A Form I-9 audit and additionally an E-Verify audit, depending on the state, is just going through and ensuring that all the employees of that company, of the target company, are authorized to work in the U.S. Now, this is something that's simple that all of you have done before, but you may not have recognized that you've done it. When you start a new job, you're required to fill out a Form I-9, right? And it's that document for all new hires that have to be done within, you have to fill out one part of it within the first day and the second part within Section 2 within 3 days of employment. And it's a document that you fill out, and you also provide documentation to prove your employment authorization. So when it comes to acquisitions, right, and due diligence, the USCIS, which is the government agency that sort of tackles Form I-9 issues and E-Verify and sets the rules and regulations, the administrative agency that does that, they said you have two options, right? So when you acquire a company, merge with a company, when there's a change of ownership, right, you have two different options that you can either, one, choose to, label these people as new hires, right? And in that circumstance, you have to complete a new Form I-9, or you can continue their employment, in which case you can keep and sort of maintain the previously completed Form I-9s from the seller, with the understanding that the potential errors and omissions and liability that comes with that remains with you, right? So if you do keep those I-9s on file, any type of ICE audit or audit that comes in and penalties that come with that remain with you as the buyer. And so that's important to note, right? And so you need to understand, one, when you go through the audit, of do they have these on file? Are they correctly filled out? Have they retained them for the right amount of time that they should be retaining the documents for? And then finally, am I in a state that has mandatory E-Verify? E-Verify is the the federal service that actually requires you to take that Form I-9 and run it through a system. And that system will tell you whether or not the employee is authorized to work in the U.S. or is not, right? And so some states have mandatory E-Verify states. Some will be based on employee count. So the company's employees will determine whether or not you qualify or you're required to run the Form I-9s. And then there's also, if you're a federal contractor or subcontractor, you work with federal agencies, there may be a mandatory requirement as well for you to conduct E-Verify. From our perspective, we'll talk about this a little bit more in the future, but this is something that we like to do and we think is important to do, because ultimately those error omissions come with you. And so you want to make sure, one, that you're taking on employees who are authorized to work, and two, that they have the correct documentation in case of an audit. And from a people perspective, right, and for your perspective, one of the things you don't want to do is take over, let's say, a company of 15 people or maybe 30 people and find out that 5 of those people are not authorized to work in the U.S. Because once you figure that out, you can't keep them. They're very clear that these people need to be terminated out of your system. If not, then you have bigger things to worry about when it comes to audits. And so, at that point, then now you're releasing 5 people day one. You need to actually refill, you got to backfill those positions. They could be key personnel, right? And that could be a pretty big hit to what you're attempting to do. And so it's really important to understand that you should do this ahead of time, right? These documents should be requested prior to close. They should be reviewed, and you should understand whether or not you have employees who are unauthorized to work, or potentially if their documents are filled out incorrectly. These things are correctable, right? So you can get new documents. You can get you can change documents, right? So if there's an error on it, right, or it's filled out incorrectly, you can actually go ahead and make changes to documents or get a whole new document altogether. So this is something that's absolutely correctable, but it's something you need to be able to do during the process. Mark, in your
There's one
experience, yeah, go
there's
ahead.
one question that Jeff posed in the chat, and the question is if the acquired employee continues their employment post acquisition and the previous I-9, the buyer keeps the previous I-9. Would you recommend still that the buyer get new I-9s even though the original hire date stays as is?
Okay, so if you keep their employment, if you continue to keep them as continuing employment, the question is, would you still get new I-9s? Is that the question?
Yes, that's the way I interpret it. Yes.
Okay. All right. Yeah, it's very much going to be based on the diligence that you go through, right? It absolutely could be something where you just get new I-9s if you want to feel safe, and you can. There's no guidance that says you can't get new I-9s. It's the time to do it now if you want to do it. And you can feel comfortable right at that point that they are correct, right? You have updated documents. This is the time to do it, if any. You don't want to be going back later on, after the sale has gone through, especially because, it could potentially be late if you do it right then and there. So I think it's a good question, and it is something that you should consider. I think really what you want to do is go through and do the audit first, understand do you need new ones or not, and then from there do it. It is sort of a heavy lift, right? Depending on how many employees you have to have them come in. They have to bring all their documents. There's list A, B, and C documents that they have to bring in, and then they have to fill out the new forms. And you, as a team, also have to fill out section 2 as well. So it can be a little bit of a heavy lift depending on the size of the company and how many employees that you're dealing with, but it may be worth it in the end.
Thank you for the question, Jeff. I've got good news. We're halfway through, and we haven't lost anybody. So thank you for staying with us, Anthony. You're doing a great job. Let's go to the next slide.
Yeah, absolutely. I think, Mark, that's because I started with those hilarious memes. I think that's the reason why they've stuck through. They're hoping for some more. I won't tell you if there is or is not. I want you to stay on. So the next slide we have here is this is a sample of like our checklist that we provide as a request list that you can provide then to the seller of things that you should be requesting so that we can do an audit or an audit can be completed. From your perspective, Mark, what do you really think in your experience doing these and working with buyers? What are the key documents that they should be requesting?
In terms of what's on this slide, or
No. In general, just what you've experienced in your time. What things should they be worried about?
well, they should be requesting everything that's on this slide. Are you referring to non-HR? I don't. What are you trying to steer me
Yeah,
towards?
no. HR related documents. So I've
Yeah,
got things on the slide, right, that I think are important and we think are employment agreements, your payroll records, your Form I-9s. But is there anything that sticks out to you that maybe they're not requesting that they should be?
I think the biggest thing is of what you're requesting. What do they not have, right?
Yeah,
And I
good
think
point.
I think that's really can be the more telling thing. An example would be job descriptions. You would think it's fairly common for companies to have job descriptions, but I can tell you, for a company that maybe has never went through a sales process before, and they don't have in-house HR department, or they're not using a PEO, they're likely not going to have updated job descriptions. Which job description, not to get on a tangent, very very important document for legal reasons. So that's kind of how I view like the document request list. I think it's important to be, certainly like exhaustive, like during the due diligence process, and ask for all of the things and items, on the slide, and you'll get a good sense pretty early on, how professionalized or under professionalized,
Absolutely.
their HR department is.
Yeah, I think you make a great point at the end there, right? Whether they are professionalized or not at this point. And that could come with good and bad, right? Because maybe you have a clean slate to work with, but I always find it's best that there's already documents there. And if they're not, one of the things we could do during this process is actually request that they create these documents. And job descriptions is a great one. If you don't have a job description for you, how do you know what these people are supposed to be doing? You're going to have to take charge of these people on day one. You know, they come to you, maybe they're doing the wrong job daily, but you don't know what they're supposed to be doing. From a legal perspective, it's the first line of defense when it comes to, looking at their exemptions and if they should be exempt. It's not the end all be all, but it's a great starting place. One of the other things that we see as well too is an org chart, understanding what is the hierarchy, who should be there, who reports to who has what type of interest. And so these are really important things that if, we request them and if they don't have them, you should absolutely ask them to create them. And you can have them be created prior to the close. And that way you have those documents in place, you understand what each one of these people do. We have on the list employment agreements and restrictive covenants. We have a slide. We're going to talk about that a little bit more thoroughly on reviewing the agreements that they have in place and then potentially getting new agreements. Payroll records are important, in order to understand what's going on, right? But also because there's retention requirements in states. And so certain documents have to be retained for a specific period of time. And so we always recommend, making sure you request at a minimum up to what the remaining what the retention requirements are for those types of documents. And then there may be state relevant documents that come up. So some states have required new hire notices. Some states have required termination notices, right, that need to be provided to employees. And so going through and having all of that documentation, so in case something comes up in the future that you have it, is extremely important. We're happy, and I know, Mark, we've done this in the past, so I'm kind of going off cue here, but I'm sure you'll be fine with it. We are happy to share our checklist, right? If anybody does have any questions or wants to request it, we can absolutely share our checklist, and something that you can use either going forward, or if you reach out to us, right, you can reuse us too. But the checklist is important to at least give you an understanding of like what we identify as key items and things that should be requested from the target company. So that you can both understand if you're complying or if they don't have the documents at all, like Mark said, which is a great way to understand what your potential gaps are and the red flags that come with those gaps.
And conversely, if you are running a company or you work for a company that you think is gonna sell at some point in the next few years, having all your ducks in a row, you see the list here, right? Like being able to check all of these to ensure that you have all these documents updated and in place is a great signal to send to anybody that's looking to acquire your company. So, leveraging a PEO or any other HR resource you can to ensure you have all your ducks in a row, like the examples listed here, is another way to look at this.
Yeah. And one of the things we've also seen, before we move to the next slide, is unfortunately we've seen sellers who refuse to provide documents. One, I think that's a red flag. Is it something that's the end of the world? Maybe, depending on the type of documents. Not all the time, though. But if they are refusing to provide certain documents, you have to think to yourself, is this a seller that I want to work with long term, right? If they're going to withhold documents from me that I can't see till post close, or I can't see till a certain point is met. You already have an NDA on file, right? You've already given them the indication really that you want to take over this company and you're looking to purchase the company. So if they are refusing to share some of these documents, that could be a key indicator as well too. So even not even having the documents, but just not even sharing them with you can be something that you really need to understand if that's going to be the case, right? And so that's where the checklist can come in handy, right? You provide it to them and they'll let you know if they're going to share those documents or not. So moving on to, one of my favorite topics and something that's, near and dear to my heart, because this is my background. EPLI is employment practices liability coverage. This is the type of coverages that cover defense costs and damages related to employee relations claims. So you think of wrongful termination, discrimination, harassment, whistleblower, retaliation. It'll depend on your policy, right? And you may have wage and hour coverage in there as well too. Most policies don't necessarily come with that. It's normally an add-on. But this sort of ducktails into our whole conversation about, this is a people thing. When you take over a business, you're taking over people, and these are the types of claims that come from those people, right? They're alleging some type of wrongful termination due to discrimination or harassment or retaliation. So for our purposes, one, we want to understand, does the company have EPLI coverage? Are you going to have EPLI coverage, or do you need to secure EPLI coverage? And two, do they have any losses from that, right? Have they had any claims, or do they have a history of legal disputes, both workers' comp related, which actually isn't under EPLI, but it's important to know that as well too. We'll talk about that in the benefits section. Do they have any legal disputes, around regulatory issues? Have they had audits before? How did they do during those audits? Did they have settlements with employees or actual litigation that took place? Once again, it's a red flag if they have a history of this, because they likely have a history of not treating their people very well if there's multiple claims. Unfortunately, it's the cost of doing business that every now and then you will potentially have a claim, whether it's nuisance claim or it's something that, you really didn't have control over. But a history of claims is something to be a red flag, or to highlight as a red flag. So the loss run report will show you whether or not they had have claims, what the settlement value was, what the types of claims those were. And so one of the things you want to do during this process is to request those loss runs. And so you can get a detailed outlook of how they've done in the past, right? Are they treating their employees well? And potentially, and this is the big one, right? Especially when it comes to like a stock deal, are there any pending litigation, or is there any pending litigation right now? If there is this something you want to take over, right? Is this something that you want to inherit potentially? Or, did they just recently settle a large claim? Are those employees still working there? Has the settlement been paid off completely? Is there any additional obligations on the employer going forward post settlement or post end of the lawsuit? And so these are all things you really want to consider. I've got percentages up there of the types of claims that you can see, and the percentages that the EEOC has actually reported. And those percentages are going to add up more than 100%, because they could be dual filed claims, right, or claims that have multiple filings on them, right? You have race and sex included on one. But ultimately last year there was 81,000 charges filed for some type of discrimination across. So these are things you'll see. You'll see these types of claims more than you'll see other types of claims, especially the larger the employee base you have. It's just something that comes up. So it's really important, one, that you ensure that you have your coverage, and then you understand what their losses were prior to taking over. Mark, anything to add on this slide?
Yeah, just one thing is, if it's very important to read the fine print on the policy, if the target company has an EPL policy in place already, particularly if it's a stock deal, you want to make sure you're not going to be on the hook for any claims that occurred prior to the close date but were filed after. That sometimes is a gray area that is usually brought up at the 11th hour in acquisitions.
Yep.
So you want to make sure you're on top of that from the get-go.
And there are ways to cover for that, right? While we're getting to the nitty-gritty details of these types of things, you could potentially have, if the coverage isn't going to roll over to you, or if the coverage is ending, you could potentially have the seller purchase a tail of coverage. Now, normally, they can be pretty pricey, and so that's something you want to build in. But you couldn't purchase a tail coverage that provides additional coverage past the policy end date, or past the transfer of the claim, or excuse me, of the policy. And why that's important is, depending on if it's a claims made policy or it's a some other type of policy, right? There could be a lot of different ways you structure it. It could be that you take over, the claim has facts that are back when you weren't the owner of the company, but the claim is made today. And if it's a claims made policy, potentially you could be on the hook for that as the new owner. And so you want to be really careful about that. And so one of the things you could do is potentially set up some type of tail coverage for that, and make sure that you get your own coverages as well too. One of the things that's great about a PEO is we do offer coverages as well. And so the PEOs do protect and allow for coverage for their clients. And so that's an important distinction to note. Or you could always go out to the market and get your own EPLI policy. And we always recommend having it, of course. I did see that TJ put in there that into the chat that it's important to note that when the economy goes bad, claims tend to go up, and that's absolutely true. Unfortunately, plaintiffs firms and the plaintiffs bar normally do really well in a bad economy, and that's just because claims do go up, the amount of claims go up, and sort of your ambulance chasers really get out there and come after you. And people are hurting for money, right? People are getting laid off potentially from a bad economy. And so these claims are absolutely going to go up in those circumstances. So most of the economy does bad. Plaintiffs' law firms normally do pretty good. So I think that's a great point, TJ, and thank you for bringing that up. I don't see any questions about this one right now, Mark. So we're going to just go ahead and move to the next slide, which is something we gave a little bit of insight to earlier. It's the idea of restrictive covenants and agreements that are so there's really two ways to look at this. There's do your employees or do the target company employees already have these things in place? And then the second component of is do you need to have them in place right day one? Have you identified a key employee that potentially you should offer some type of agreement to? Now, from the flip side of the perspective, right, and you'll get this from your legal counsel when it comes to the acquisition, is potentially having a non-compete for the prior owner or non-solicit for the prior owner. That's something that you won't go through your HR diligence for. You'll have that worked out with your attorney team on the buy side. I think it's important, right, and definitely discuss that with them if you haven't already, because you want to make sure. Unfortunately, we've seen these things play out where buyers can be nefarious in the ways that they potentially start to open up a new business right next door to you, right? Or they start to take your key employees. So you want those things locked up. But for today's purposes, we're going to focus on the actual employees themselves, right? And whether or not they have these agreements in place or they don't. So just from a high level, right, a non-solicitation is agreement between you and the employee that says, during their tenure with the company and for a period after their tenure with the company, they're not going to solicit your customers. They're not going to solicit your clients, your vendors, your current employees away from you, right, into a different company or to their own company. These traditionally hold up, right, especially if they're limited to a specific scope and period of time. Most states, for the most part, allow these. From the non-complete perspective, this is the idea that your employee is not going to enter into competition with another employer in the same type of business or same type of industry as you within a specific geographic radius, both during their employment and after their employment for a specific period of time. Just recently we had the Federal Trade Commission announce, a couple months back now, it's been a little while, a ban on non-competes. This was the first time that the federal government has attempted to ban non-competes nationwide. That was, ultimately issued a stay and then overturned in legal proceedings. But there are several states out there that still at this point do not require non-compete or do not allow non-competes, excuse me, or have severe limitations on who can be issued a non-compete and for how long. And so it's important to notate that. The reason we bring it up is you want to understand if your employees are in these types of agreements, and if they're going to transfer over to you when you take over the business. And that includes employment agreements. So an employment agreement is what you offer to your employee to either give them additional or different terms of services, right, than an employee would traditionally have. And so this is normally, maybe changing the at-will employment to for cause. This is maybe a term of employment, right, for a specific period of time, or if you want to give them some type of additional responsibilities or benefits, right, that you wouldn't normally give to an employee. Those are the times you would offer an employment agreement. And so that really brings us to the second component of this is have you identified a key employee? And if so, do you think you need to do something to keep them? So employment agreements are ways to do that. You could also offer some type of retention benefit within these agreements or just a retention agreement as well too, in which you're giving them some type of carrot to either stay with you for a specific period of time or meet certain goals. And those are good ways to structure it so that the employee wants to stay on. They feel like they have some type of incentive to stay with you. And it's important to do so because a lot of times when we're buying these small businesses, there really are, 1 to 2 key contributors who have a lot of institutional knowledge and operational knowledge. And for your perspective, it could be extremely important to retain these people. There's a couple different ways to do it, right? You could do it through an employment agreement. You could also make sure that, and we've seen this plenty of times, Mark, I know you could comment on this, that you could build it into the purchase agreement as well, too. That, in order for you to purchase this company, Jane Smith has to, sign some type of employment agreement or retention agreement to stay on with you for a period of time. Mark, is that something you've seen as well, too?
Yeah. I mean, it could be a standard closing condition
Mm-hmm.
that's part of a transaction. So, yeah, very, I would say, common, particularly to address a scenario where there's a key employee that's not technically a seller of the
Mm-hmm.
business. So yeah, very, very common scenario. You want to move on to the next slide?
Yeah, absolutely. So we'll move on. Um, just lost my That's there we go. All right. So we're going to go quickly through an HR diligence study, and then we'll get to the benefits portion of it. So, this is one of the diligences that we actually went through. And so this is a real live one that we conducted. It was a manufacturing company in Texas, 58 employees. Scope was employee handbook, I-9, EPLI claim loss. We did a technology review, among other things. But really, what the primary focus and what a big part of the focus was the I-9 portion of it. The company ultimately did have a strong HR foundation, right? They had certain things that need to be updated in the handbook, but these are always things that can be updated. But being in Texas, close to the border, unauthorized employees is something we can see, right, and is something to be wary of, right, in that specific part of the country. And so ultimately, what we actually were able to find is that there were, both unauthorized employees and improperly executed or completely expired I-9s, right, that required reauthorization of the documents. The good thing though is that we were able to identify that early on in the process, and they were able to correct those documents or go back to the employees and get different documents or new updated documents throughout the process. And so ultimately they were able to identify this early and correct it. And that's the big thing about a diligence process, right? Is being able to identify red flags and fix them either ahead of time or day one. And so they were able to do that. And I think it's important because they avoided potential penalties and losing employees. So I mean, that's just a quick, really quick and minute, focus on one particular type of case study that we did. Mark, I want to turn it over to you because I know you want to get to the benefits portion as well too. So you want to
Yeah,
just go
just
over
a
and talk about
quick
this?
summary on what we provide as a PO. So I'm not going to go over all of this at all, but there is obviously a very important benefits component of our offering across all of these different types of policies. But the point though is we actually look under the hood in the event of a acquisition that one of our clients has undertaken to help them uncover maybe there's some opportunity to improve the target company's benefit program by coming on to the Aspen HR benefit program. So if you go to the next slide here, you'll see a few considerations. First is, you really need to understand, if you're looking at an acquisition that you're going to merge into your existing company, what are the differences in the plan designs, co-pays, both, for your primary care, certainly specialist care. We've seen co-pays increase significantly in recent years, deductibles, and ensure that if you are going to, merge the medical plan of the target company into yours, that ideally that's an upgrade, for the employees of that target company, not a downgrade in that, they would have to pay, higher co-pays and have larger deductibles. The other thing too, and this is really important for employees that, are seeing specialists for certain conditions or have a procedure that's already scheduled. Maybe it could be a pregnancy or some other operation, that you have to be very mindful that those specialists and hospitals are in network with the new carrier if they are going to switch carriers. So looking at that in advance, it's really easy to confirm that. Obviously, as a PO, we help our clients confirm all of this information, but be very mindful to ensure continuity of coverage. The other thing too is, thinking strategically about, renewal dates. If the renewal dates are going to be different, you have a different renewal date than the target company. It could make a lot of sense to, quote the combined business off of one consolidated census, which, with greater scale could be an opportunity to even improve, and upgrade the plan options and have reduced rates. So taking a strategic look and quoting the combined census of the combined company, could make a lot of sense post close. And then lastly, and this is really important, just ensuring that you have alignment in the contribution strategy between your company and the target company. We've seen so many different contribution strategies out there. Employer, when I refer to this, I'm referring to, how much an employer contributes to the medical insurance, dental, life vision, all the ancillary products. We've seen it all across the board. So very similar to the theme for this slide is to ensure that that the new contribution strategy is going to be an upgrade ideally for the employees who are being acquired versus a downgrade. Just to close up, we have a couple case studies to go through.
Yeah, one thing I want to talk about, Mark, as well too, is something you had brought up earlier,
Hmm.
is that, and I'm going to move to the case study slide as well in the meantime. But one of the things you had brought up is carve outs, right? And how carve outs can be
Yes.
how your benefits can be impacted by a carve out. And one of the things we've seen sort of multiple times now, and it's good to at least highlight it and give the buyer perspective ahead of time, is that depending on the size of the company you're carving out from the ultimate larger group, you could end up ultimately with a pretty significant increase in the benefits. Or sometimes, right, in the rare case, and it's great, you could actually end up with a benefit right out of that. But it's important to note that, like, once you take a smaller sample group right out of a larger, things can change, right? You could be taking on, high liability individuals. Maybe it's the higher age group of people that are in there, or they have lots of hits ultimately to the policy. Or alternative, right? Maybe you're carving out a better sample size, right? And so it ends up being better for you. But it's an important thing to note, right? And we've seen it time and time again from carve outs that it's not something most buyers anticipate, and then it hits them when they come to renewal and they wait a minute, what happened? We thought we were going to get this, and now we're here.
Yeah, it's a great point. And we got a couple minutes. I just want to finish up real quick, on some practical examples. You can see here, this is a recent benefits diligence example where, we actually, ran, this is a grown company. We looked at various options and, the open market, did a benchmarking analysis, compared it to our large group medical plan partnership through Aetna. And, in this case, actually we're able to obtain particularly for a company this size, I mean, 13 employees, it was unbelievable savings. And, you can see here about 130,000 annual savings, which, partially was reinvested to offer some new programs to increase the employer contribution to the benefits. So this is a great example of a recent case study where, we were able to identify significant value enhancement to the benefits program for this target company. And then, Anthony, you want to close up with just the HR diligence example?
Yeah, we hit that one already, Mark. So that one's already actually
Okay.
completed. So,
Okay.
we have 5 minutes left. I think we could take this time, Mark, if you're okay with it, and we can open up the chat and see if anybody has any questions. And if not, right, if you have any questions, you could always reach out to us via email and we'll answer them. But if you do have questions, you want to throw them in the chat or the Q&A function right now, we'll be happy to answer them. And we'll take a look at that for a moment as well, too.
Thank you. And just a reminder, this is again a service that's complementary to Aspen clients, and so reach out to us if you have a potential acquisition that you want us to help evaluate from an HR and benefits perspective. If you're not a client yet, we work with a lot of companies that are not clients and provide this service on an a la carte basis as well. So.
Yeah, great point. Well, Mark, I'm not seeing anything in the chat. So, if you are shy, right, and you want to email us separately, please do so. We'll be happy to answer any questions that come in, give you some guidance. I do see a hand raised from TJ. TJ, I'm going to go ahead and allow your mic, okay? I'm going to turn it on here for a moment. Okay, you should be able to unmute yourself, TJ, if you have any questions.
Listen, just as somebody who's been in the industry for 20 years, I can honestly say you guys are by far the only PEO I've ever seen or that I've ever been a part of that offered this to clients. Usually it is the PEO or the salesperson dealing with the afterflow. And what I mean by that is the client calling them up after and saying, we bought this company in Texas, this company in Ohio, and you're playing catch up after the fact. This is a great offering, especially to the private equity and venture capital world, because it gives them another set of eyes where they don't normally think about this stuff. And it's their second thing that's going to bite their investment in the butt, so to speak. So I just wanted to say, I've seen a million of these demos over the years, and the way you guys approach this is a great concept. The way you guys put this out there for your clients, I can honestly say I don't think anybody else does this.
Thank you, TJ. Please send me your Venmo when you have a second.
Yeah,
we're very good.
And thank you all for the comments. We see you. We appreciate you guys all attending. I know it's tough taking time out of your day to do something like this, and so we very much appreciate it. If you do have questions, please reach out to us directly, and please look out in the future, right? We do perform other types of webinars as well, too, so we'll have some more in the future as well. So thank you all, and have a great rest of your day. Take care.
Thanks, guys.